Hello everyone, I'm Yali Jiang. Gold and silver just took a sharp hit in international markets, driven by a strengthening dollar and a broad-based sell-off across risk assets. This isn't just another down day. This is a coordinated move that reveals something deeper about how investors are repositioning ahead of what could be a major shift in monetary policy expectations. And if you're holding precious metals or thinking about it, what happens next could determine whether you're protecting wealth or watching it erode. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. This isn't surface-level news. This is about understanding the machinery behind the price action. Let me walk you through the numbers. Silver dropped below $29 per ounce this week, falling more than 3% in a single session. Gold declined as well, slipping under $2,700. Now, on their own, these moves might seem like normal volatility. But when you put them in context with what's happening in currency markets, treasury yields, and broader equity sell-offs, the picture becomes much clearer. The dollar index rallied above 107, its strongest level in months. And when the dollar strengthens like this, it puts immediate downward pressure on commodities priced in dollars. That's the mechanical relationship. But the question is, why is the dollar rallying now? And what does that tell us about investor confidence? Look closely at this trend. The dollar's strength isn't coming from economic optimism. It's coming from safe haven flows and speculation that the Federal Reserve may hold interest rates higher for longer than markets had priced in. We've seen Treasury yields climb back above 4.3% on the 10-year note. That's significant. Higher yields make non-yielding assets like gold and silver less attractive on a relative basis. Investors start asking themselves, why hold metal that pays nothing when I can lock in 4% or more in government bonds with no storage costs and complete liquidity? Now notice what changed. Just a few weeks ago, markets were pricing in multiple rate cuts for 2025. That narrative has collapsed. Economic data came in hotter than expected. Inflation metrics remained sticky. Employment numbers stayed resilient. And suddenly, the urgency to cut rates has evaporated. The Fed's own messaging has turned more hawkish. And when that happens, real interest rates rise. Real rates are the enemy of precious metals. They represent the opportunity cost of holding assets that generate no income. And right now, that cost is rising. But here's where it becomes important. Silver is not just gold's little brother. It has a dual identity. It's both a monetary metal and an industrial commodity. And that makes its behavior more complex and, frankly, more interesting. On the monetary side, silver tracks gold's response to inflation fears, currency debasement, and geopolitical risk. But on the industrial side, it responds to manufacturing demand, electronics production, solar panel installations, and electric vehicle growth. So when you see silver selling off, you have to ask, is this monetary demand collapsing, or is industrial demand weakening, or both? Right now, it looks like both forces are at work. The broader equity sell-off tells us that growth expectations are being repriced lower. Tech stocks have pulled back. Consumer discretionary names are under pressure. Industrial commodities like copper have softened. That suggests demand concerns are spreading. And if global manufacturing slows, silver's industrial consumption takes a hit. At the same time, the strengthening dollar and rising real rates are crushing the monetary bid. So silver is getting squeezed from both directions. Let me show you what's happening in the ETF market. Silver-backed exchange-traded funds have seen outflows over the past 2 weeks. Not massive, but consistent. That tells us retail and institutional investors are reducing exposure. They're not panic selling, but they're trimming positions. Meanwhile, gold ETFs have held steadier with only modest outflows. That divergence is telling. It suggests that investors still see gold as a long-term hedge, but they're less convinced about silver's near-term prospects. And that makes sense. Silver is more volatile. It's more sensitive to industrial cycles. And when uncertainty rises, investors tend to migrate toward the safer, more liquid asset, which is gold. This pattern has appeared before. Go back to late 2018 when the Fed was tightening and the dollar was surging. Silver fell harder than gold. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, spiked above 85. We're not quite there yet. Right now, the ratio is sitting around 93, but it's widening. And historically, when that ratio moves above 90, it signals that silver is underperforming, either because industrial demand is soft, or because monetary demand is weak, or again, both. Now, let's talk about supply. This is where the story gets more nuanced. Silver mine production has been relatively flat for years. There's no major new supply coming online. In fact, many of the world's largest silver-producing mines are in regions facing political instability, environmental challenges, or rising production costs. Mexico, Peru, China, and Australia account for the bulk of global output, and none of them are ramping up production significantly. So supply is constrained. But here's the thing. When demand falls, even constrained supply doesn't matter. Prices still drop. And right now, demand is the problem. On the industrial side, solar panel installations are still growing, but at a slower pace than forecast. Electric vehicle sales are strong, but margins are compressing, and manufacturers are looking for cost savings. That means they're scrutinizing every input, including silver. Electronics demand remains solid, but it's not accelerating. So the growth story that drove silver higher in 2020 and 2021 has moderated. It's still there, but it's not explosive. On the monetary side, the lack of inflation panic is removing one of silver's key drivers. Yes, inflation is still above the Fed's target, but it's not accelerating. It's not out of control. And as long as central banks appear to have a handle on it, the fear trade in precious metals diminishes. Investors stop buying metal as insurance against currency collapse or runaway price increases. They shift back to traditional assets, equities, bonds, real estate. But here's where it becomes critical to think long term. The current sell-off in gold and silver doesn't mean the structural case for precious metals has disappeared. It means the market is repricing based on short-term factors: dollar strength, rate expectations, risk-off sentiment. But those factors are cyclical. They change. What doesn't change is the fundamental reality that governments around the world are carrying record levels of debt. Central banks have massively expanded their balance sheets. Fiscal deficits remain enormous. And at some point, those imbalances will create conditions that favor hard assets again. So what does this suggest about inflation? The market is currently betting that inflation will continue to moderate, that central banks can engineer a soft landing, and that we won't see a return to the high inflation of 2022. But that's a bet, not a certainty. If growth slows too much, central banks will pivot back to easing. And if they ease aggressively, inflation could reaccelerate. In that scenario, precious metals would rally hard. The current sell-off would look like a buying opportunity in hindsight. What does this suggest about currency confidence? The dollar's strength right now is relative. It's strong compared to the euro, the yen, the pound. But that doesn't mean it's strong in absolute terms. The dollar has lost significant purchasing power over the past decade. And as long as fiscal and monetary policy remain loose over the long run, that erosion will continue. Gold and silver are hedges against that erosion. They're not perfect hedges, and they're certainly not short-term trading vehicles. But over multi-year horizons, they preserve value when fiat currencies do not. What does this suggest about investment psychology? Right now, the market is in risk-off mode, but it's not in panic mode. Investors are reducing exposure to volatile assets, but they're not fleeing to bunkers. That's why you're seeing sell-offs in stocks, commodities, and crypto. But you're also seeing flows into treasuries and the dollar. It's a rotation, not a collapse. And in that environment, precious metals get sold along with everything else. But if the sell-off deepens, if we move from rotation to real fear, then gold and silver could reverse sharply. Because when panic sets in, investors remember what they're really for. So where does this leave us? The immediate outlook for silver is challenging. The dollar is strong. Real rates are rising. Industrial demand is soft. Monetary demand is weak. All of that argues for continued pressure on prices in the near term. But the long-term case remains intact. Supply is constrained. Industrial applications are growing, even if slowly. And the macroeconomic backdrop, fiscal deficits, monetary expansion, geopolitical risk, still favors hard assets over time. If you're a long-term holder, this sell-off is noise. It's uncomfortable, but it doesn't change the thesis. If you're a trader, this is a tough environment. Silver is range-bound, choppy, and driven by headline risk. If you're thinking about entering a position, the question is whether you believe we're near a bottom. Technically, silver has support around $27. If that breaks, we could see a move toward 25. But if the dollar peaks and real rates stabilize, silver could find footing and start to recover. The key is to watch the dollar. As long as it's strengthening, precious metals will struggle. But if the dollar rolls over, if Treasury yields start to decline, if the Fed signals any dovish tilt, then gold and silver will respond. And when they do, the moves can be sharp. Silver in particular is volatile on the upside because of its smaller market size and dual nature. When it catches a bid, it can run fast. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize. This isn't just about price. It's about understanding the forces that drive value, the interplay between currencies and commodities, and the choices investors make when uncertainty rises. Stay informed, stay disciplined, and keep your eyes on the bigger picture.